Hello, everyone, and welcome. Thank you so much for joining us today for Calling All Real Estate Investors. We are here every Tuesday for this live event with Caeli Ridge at 1:30 p.m. Pacific time and 4:30 p.m. Eastern time. So thank you again for joining. Remember to please utilize the chat feature that we have here on Zoom so that we can get your questions answered. We love audience participation here. Caeli loves to answer your questions. So please send those in as they come up, and we will get to answering them as soon as we're able to throughout the call. So today, Caeli's topic will be going through what points are associated with non-owner occupied loans. So she often gets these questions. She wanted to give you all a full review and breakdown of what to expect for these types of loans during your next transaction. So handing it off to you, Caeli. Thank you so much.
Thank you, my dear. Hey, everybody. Thanks for being here on this Tuesday. Just to quantify or clarify a little bit, I think the tagline for today's live with me was, what was it? I came up with something kind of cheeky. To pay points or not to pay points? That is the question from our buddy Shakespeare. So it's going to be about that, but I also want to comment for you that I'm going to take this in a different direction. And this is, thank God it's being recorded, because I suspect that most of you are going to want to come back and re-listen to some of this, maybe more than once. We're going to get into the weeds here a little bit. I'm going to have some visual aids that I'm going to share with you guys. But even with that, it's really high level stuff, but I think that it's not going to hurt to share some of it. And I'm going to, without sounding rude, I'm going to dumb it down a little bit, because this stuff, even for me, sometimes can be a little bit overwhelming. So just we'll take our time. We're going to unpack this slowly. I anticipate we're going to run over the 30 minutes, so we may even roll into about the 2:30 hour. So if you can't make it that long, cool. It's going to be on record, so you can come back and watch where you left off. All of that said, I was up late last night, kind of putting together some notes and making sure that my delivery is going to be as concise as possible, because the content is rather complicated. So I may be reading off my cue cards here to make sure that I don't forget anything. As Carly said, please put your questions in the chat. She'll interrupt me if she thinks it's poignant and timely to the conversation, and I will stop and answer. Okay. So we are going to be talking about rates, but not necessarily just rates, more specifically paying points for an interest rate. And then I'm going to get into some of the history and the why behind the how. All right. Let's start with kind of the easy part. And I can get over this piece pretty quickly. So when does it make sense to pay points on a loan, whether it be an investment loan, a second home property, your owner occupied, whatever it is? When is it appropriate to pay points? And let me preface by saying with you guys that all of this next bit of information I'm going to give you is relative to a normal rate market. That is not where we live right now. We are not in a normal rate environment. In fact, it's quite the opposite. And while under normal circumstances, you guys get to choose, right? If anybody's had a mortgage or received a mortgage in the last 5+ years, up until recently, you know that there's been a choice between whether paying points and not paying points was up to your discretion. That is not true today. There is no zero rate option, okay? Regardless, I want to define for those that may not be familiar with this math, when does it make sense? When is it appropriate? When the choice is ours, not applicable today, but when the choice is ours, when is it a good idea to pay points and when is it not? The answer to when it is a good idea depends almost, okay, notice that my inflection on almost has a particular tone. I will come back to that in a second, but it depends almost exclusively on how long you intend to hold the property. More specifically, how long you intend to keep that particular mortgage. Because for example, if you think you're going to hold this property, let's just say that you know you're going to hold it for 5 years, okay? But within that 5 years time, before you think that you're going to offload it, sell it, do a 1031 exchange, whatever it may be, you expect that it's in a market that you expect to have some appreciation, and chances are pretty good that you're going to be refinancing it maybe prior to even selling it. So in that example, you're probably going to want to focus on not necessarily how long you're going to have this property, but specifically how long you're going to have that mortgage, because you intend to harvest some of the equity, right? You're going to do a cash out refinance. And who, by maybe show of hands really quickly, who remembers the detail about the tax advantage of borrowed funds? Anybody? I won't wait for you guys to answer. I'm just going to answer it for you. But if you'll recall, borrowed funds are non-taxable. So one of the great advantages of real estate investing, especially when you've got a balanced portfolio and you've got properties that are in markets or areas that we know it's going to show some appreciation, that in a couple of years' time or whatever it may be, we're going to do cash out refinances, pull money out, borrowed funds, non-taxable, use those funds for what? More acquisitions, more purchases, right? So that might be part of your strategy. If you know that that's going to be the case, deciding on whether or not you're going to pay points, that's your answer. If you know how long you're going to keep that mortgage, that is the primer to determining whether or not you're going to pay points, okay? The math is very simple. And many of you listening to this here and maybe later on the recorded version are very familiar with this math. In fact, it's probably one of the first bits of information you learned early on. But for the rest of you that may not be familiar with this concept, it's very, very important that you hear it, know it, and understand it. And it's not nearly as complicated as maybe it sounds on the surface. So let's dig into this really quickly, and I'm going to get into some of the higher level stuff. So if you've identified how long you're going to have the mortgage, let's say it's 2 years, 5 years, whatever the number is, then the next bit of information you need is what is the interest rate you're being quoted right now without points, okay, whatever that baseline is. Let's call it, for a round number, let's say that it's 6%, okay? You know what your loan amount is. In my example, we're going to say that the loan amount's $100,000. So you have that bit of information, you've got that data. And then we're also going to say that for every 1/8 of a percentage point, that's equivalent to 0.125, every 1/8 of a percentage point difference in rate, there will be a cost or reduction in rate. There will be an additional cost associated of 0.375. Now, I chose these numbers in advance because they're nice and easy and round. Okay, so let me just recap. Our loan amount in my scenario that we're going to figure out the math on when it makes sense to buy points down or not. We have a loan amount of $100,000. We have an interest rate that requires no points at 6%. We know that the every 1/8 of a point reduction from 6% down will come with an additional cost of 0.375. Okay, so let me fill in some of the blanks. An 1/8 of a percentage point on $100,000 is equivalent to $8 a month difference in payment. Okay, if our loan amount's $100,000, 3/8 of a percentage point or 0.375, same thing. The math, round math there is obviously $375. Okay, so follow me here. We're starting at 6%. If I want to buy my interest rate down to 5.875, that's 0.125 or 1/8 of a percentage point lower. Okay, I know that the payment difference between those two interest rates is $8 a month. And the cost in my example, and these are just random numbers, you guys, okay? The cost is 0.375 or $375. If I take 100 grand times 0.375%, that equals $375. Okay, so far, if you guys are with me, good. If not, raise your hand, put your question in there, I'll come back to it. But that's easy math stuff. Now, all you have to do with that information is take the cost, $375, and divide it by the savings, $8. What you're going to come up with is a break even of 46.8 months. Okay.
Yes,
What
so
is
Antonio just said, so it take 47 months to recoup that difference.
good, Antonio? Exactly right. Exactly right. So 47 months to recoup that upfront cost with the monthly savings that you're going to yield as a result of this. So then you go back to your original question. How long am I going to have this mortgage? How long am I going to have this property? How long am I going to have this mortgage? If you know it's at least 46.8 months, then it probably makes sense to pay that extra. Keeping in mind that there's other variables. Okay, I'm just kind of focusing on the basic piece of math. There's lots of other variables that you're going to want to consider when making this decision. Of course, there's the tax incentive. Points on an investment property are tax deductible. Okay, so there's going to be a little extra over here that might play a role depending on the circumstances and your tax brackets, et cetera, et cetera. But otherwise, if you know that you're going to have the property or the mortgage that long, Yeah, pay the points. If you know this property is going to sell in 2 years, it's just going to be a turn and burn, or maybe it's a fix and flip, right? Whatever it is, you want to avoid the points like the plague. Why would you pay that extra money unless you really need that tax incentive and you need those losses? Why would you pay points if you're not going to have the property long enough to reap the benefit or reap those rewards? So that's the math, man, right? It's as easy as it gets. So just a real quick recap. Identify how long you're going to have that mortgage. Figure out, what your rate being quoted or offered is. Figure out what the cost is for every eighth or quarter point difference in rate. And then the monthly payment divided by the cost, that gives you the number of months. Simple, simple, simple. A few other things that just to put it out there so that I'm kind of covering my butt, that would be important to remember when you're deciding. We talked about the tax incentive, right? The Schedule E and some of the write-offs that you're going to get. What is the cash flow? Does the property already cash flow really, really strong? What are the current annual rent appreciations being targeted for this property? Is it appreciating at 1% a year of rents? Is it 10%? That would be another thing to consider. Is the seller paying towards your closing costs? Is there going to be a seller paid closing cost credit that might help instead of it being your money? The seller is going to contribute towards your closing costs. Maybe that weighs in on here. So some other things to consider, but overall, the math for when to pay points and when to not pay points, when it is a choice, I'm going to keep saying this, it's not a choice today. You're going to learn why in a minute. Those are some of the things to consider. Okay, comments, questions, anybody real quick before I really dig into why I want you here today and what I want to talk about.
Yeah, Caeli, we did get some comments from David here. He said earlier, accept your pain points with today's dollars rather than tomorrow's dollars. And then he did follow that up with a question on, can you talk about pain points in today's market when we can't avoid those costs?
Absolutely.
Yes.
Dave, thank you, David. There's no choice. There is no. And let me think about this and how I want to, because there's a sequence here, guys, in terms of how to define for you why points are required right now. And I think, David, if I may, I'm going to hold that part, the actual why, off for a minute. And I want to just talk about more of the inner workings of rates. Okay. Let me just check my notes here. I already talked about that. Okay.
We did have one more question here, real
Sure.
quick, Caeli, if you wanted to. Let's see. So Mia, thank you for your question. She said she's looking for a deal where a builder said they'd buy down the rate by 2%. So what does that translate to? Is it 2% is not the same as reducing by 2%, is it?
No, it's not. Good, excellent question, Mia. So just to recap, tell me if this is incorrect. The builder is going to contribute 2%, a credit of 2% of your purchase price, not the loan amount, which by the way is what points are going to be based off of, but the seller or the builder is willing to contribute 2% of the purchase price towards your closing costs, which in this case you're going to use to buy down the rate or the points. So what that means is that if the purchase price was $100,000, the seller is going to give you a credit of $2,000 of which to use to buy down the rate. And it isn't dollar for dollar. Just because you have 2%, which translates into a dollar figure of $2,000. But that 2% doesn't mean that if you were quoted 6%, that you're going to get a 4% interest rate. That's absolutely not how it works. And I'm going to get into some of this. And remember, you guys, this is high level stuff. Okay. I expect, again, without being dismissive or rude, it's going to be over most of your heads. Sometimes it's over mine. So feel free to go back and listen to this. Let's get in. I'm going to pause on the questions now, Carly. Let's get into some of this, and anything that wasn't covered and needs to be reiterated or talked about again, we'll do it at the end. Okay. Okay. So there's something called premium pricing. Okay. Premium pricing, or lack thereof, is what's going to determine for us the cost or the credit of the rate that you're going to lock. As I've mentioned a couple of times now, our current rate environment, particularly for investment property and second home, those are getting hit harder, removes our ability to choose between paying points and not paying points. There isn't that option right now. So to lock in an interest rate for most mortgage transactions today, paying points is just a certainty. Gone are the days, at least for now, that using premium pricing as a way to avoid points is going to be that choice. So let's define premium pricing. This is when posted rates for that day or that time of the day, because rates can change throughout the day if it's a particularly volatile day in secondary, okay, mortgage-backed securities secondary. Premium pricing is that when a interest rate is posted, it's offering something called yield spread, or YSP, yield spread premium. Yield spread premium, or well, yield spread is a premium in a percentage form that is offered over and above what the cost of that loan transaction is going to mean. Okay, and that leads into something called LLPAs, loan level price adjustments. Guys, you've heard me talk about this in the past if you've been listening for any span of time. An LLPA, loan level price adjustment, is a positive or a negative number that will attach to the individual characteristics of your loan transaction. Okay. An LLPA for an owner occupied, where you're going to reside, where you're going to live, versus one that you're going to use as an investment property that you're going to rent out, is a big difference. The LLPA for an owner occupied is going to be far less because it's all risk based. And I should have prefaced by saying this. So LLPAs are basically another way of assigning risk. All right. The higher the risk, the higher the LLPAs are going to be, loan level price adjustments. And I'm going to give you guys a visual aid here in just a second. So some of the variables that are the details, or how I can explain the LLPAs. We talked about occupancy, owner occupied versus non-owner occupied is a pretty big one. You've also got loan size, loan amount can also be a pretty big LLPA difference. The difference between a $50,000 loan amount versus a $500,000 loan amount, pretty big difference. You've got property type, single family residence versus a 2 to 4 unit property. We've got credit score can be an LLPA, pretty significant LLPA. A lower credit score is going to have a higher LLPA versus a higher credit score. Might even have a benefit, a positive number to the LLPA, because remember I said that the LLPA is a positive or a negative number. Transaction type, is this a purchase? Is it a refinance? Is the refinance a rate and term refinance, or is it a cash out refinance? So all of these variables and a lot more are going to dictate what your actual interest rate becomes, or what you lock at, and whether there's points or not. Right now there's going to be points. And that's how we're going to figure it out. There's going to be a raw price once we have gone through what's called a rate sheet, and that's going to be my visual aid here. Once we've identified what all of those variables are specific to the transaction that you're trying to close on, and then we're going to take that LLPA raw number and we're going to look at that YSP, that yield spread number. The yield spread is going to be a premium that is attached to that specific interest rate on that day. Okay, I think I'm going to pull up my visual aid. I think there was something else that I was going to mention here, but maybe I'll come back to that. So let's go like this. Share screen. I want to be on this one, I think, guys. Okay, this is going to be like looking at Greek. Okay, can you see what looks like a bunch of numbers and boxes and stuff? Okay. So what this is, what you're looking at, this is an old school rate sheet. We don't use these anymore. I found this one as a nice example so that you guys had that visual aid. Because if I just started spitting off all kinds of numbers for you, I don't know about you, I wouldn't be able to follow it. So I wanted you to watch and see what we go through old school. It's still the same. It still comes out to be the same number, but we used to do it just like this manually. I'd have printed paper rate sheets on my desk every morning, and I would be able to highlight the individual transaction that I was pricing for a quote for a borrower. And I would go through with a highlighter and I would figure out what all of the variables associated with that transaction were. And I would be able to get a raw price and then ultimately an interest rate. You'll see what I mean in a second. So everybody, is this big enough? Can you guys see it? Do I need to make it bigger? Is it, Carly, is it legible? You think they can see that okay?
I can see it. If anyone is having trouble, please let us know in the chat.
Okay. Anyway, so this is just one. You'll notice down here at the bottom, there's lots of different products here. We're just going to focus. I just picked this one. It doesn't even matter. for our example, it's irrelevant. So I want you to focus on this 30-year fix. These are going to be the interest rates. Okay, and this is going to look kind of funny. These numbers here are going to look kind of funny, but you'll notice that some of them are below 100, some of them are above 100. So when you get to the 100, so 100.125.
Let's see, Caeli. Sorry, before you get too far ahead, could you make it a
Sure.
little bigger if possible?
Yeah, let's see if I can. Let's go like this. How's that, guys? That should be good.
Yes.
I don't think I can make it bigger and keep it on the screen. Okay. So we're going to focus on the 30-year fixed rate. Okay, so these are 30-year fixed. You'll notice there's a 15, a 10, 10-year ARM, 7-year yada yada. Here's the rate here in column A. Here are the 30-year fixed rates. I'll come back to kind of what some of these mean in a second, but just to say that anything over 100.00 is a premium. Okay, this is going to be a cost. And this is an old rate sheet, so this is just for example purposes only. All right, so these are the rates. And then below here is the matrix in which that they have all those LLPAs. You'll notice see these positive and negative numbers here. So you'll also notice here adjustment to price. If this were to say adjustment to rate, these LLPAs would be an addition or a subtraction to the actual interest rate. It says adjustment to price because it is to the premium that will be associated with the rate. All right. So the first thing that I'm going to do is I'm going to identify what my loan to value is, my LTV, and that's going to go across this row right here. Okay, it starts at 50 and below as an LTV. 50.01 to 55 is another bracket of LTV, another column. 55 to 60, 60 to 65, so on and so forth. Okay, so we're going to say in my example that we're starting at a 75% LTV. So I'm going to be right here. So I know that I'm going to follow this column all the way down. And if you'll notice, all the way down here are all of those associated LLPAs. So I've got to figure out going from, left to right, which one of these applies to me and my scenario. All right. So let's just I'm just going to make this up off the top of my head. So here we are. And here are my credit scores that I have to work with. So in my example, I'm going to try and keep this easy for myself. So I'm not trying to have to crunch numbers or do math. I'm going to say that my client has a 760 credit score. Okay, so I'm going to start here. I'm going to take it all the way over to my 75%. It's a 0.00. There's no hit for that individual. Okay, so let's highlight that so I don't lose my place. And this assumes that this is the kind of income that this individual is showing. You'll notice that there's some additional add-ons down here if they were less than 24 months of bank statements, right? This is just the product. So this is the bucket that I found myself in. These aren't going to be applicable down this one, this one, this one, this one, or this one. But now I got to go back down here to all those other variables. So debt to income ratio. My borrower's debt to income ratio is going to be under 50%, okay? But above 43%. So I'm going to fall there, another 0. This tells me that if it's in excess of 50%, that they can't get this, the max is 50% DTI. You guys don't have to worry about that. Okay, next is my loan amount. So if you notice right here, all the way to the left, the adjustments are going to be debt to income ratio, loan balance, purpose, occupancy, some of the things that I mentioned initially. So we'll go through these one at a time. So the loan amount in this case is going to be 175,000. Okay, that's my loan amount. So this one does apply to me. That is a negative 0.625. Whoops, let me highlight that guy for us too. So I've got to highlight that. Okay, that's the LLPA for loan balance. This is going to be a cash out refinance. Okay, it's another 0.625 cost. It is an investment property, another 3/8 of a percentage point. I'm going to have to use my calculator on this. It is a 2 to 4 unit, another 1/4 point. Okay, the state is eligible. I'm not going to worry about that. Amortization, we're going to say it's a 30-year interest only. Fine, another 3/8 of a point. So you guys kind of start to get the premise here. I got to go through all of these. Right now, we don't use a manual rate sheet. We have a system that's got all the information in it. We plug in the variables and it spits out what the interest rates are and what the cost or credit would be if that was applicable. Escrow waiver, no, no, no. Okay, so I'm just going to leave it there. So let's just go ahead and come up with our raw price. Okay, so let's go. Let's see if I can figure this out on my own. So there's 1 point, there's 2.25. So it looks like I've got 2.25 in total costs. So if you guys want to follow along, 0.625 times 2, there's 2 of those, right? There's 2 3/8 plus 0.375 plus 0.375 plus what was the other one? 0.25. Okay, so 2.25. What did I say? 2.5? I guess I got that wrong. Did I get them all? 1, 2, yeah, 2.25. So 2.25 is the total raw LLPA. Okay, those are my adds for the variables of this particular example, this particular transaction. You'll notice this is a non-QM product that I'm pricing off of, that if there were prepayment penalties or you wanted to buy out a prepayment penalty, there's going to be an additional cost there. So that's something else to consider. Prepayment penalties on non-QM typically will give you better pricing. Anyway, so we have a 2.25 LLPA. So now what I want to do for this, it's a negative number, right? All of these are negative. Let me see if I can give you a quick example of where we could have benefited in the rate somewhere. So let's say that you had a 780 or better credit score in this example. I'd be able to take 0.25% off. So instead of it being 2.25, right, it's going to be 2% because I have an improvement for this particular credit score. That's a positive number. Hopefully you guys are following. But that's not my case here. 2.25 is my raw LLPA. So now what I'm going to do with this information is I'm going to come back over here to the 30-year fixed column of rates. And what I'm looking for is the yield spread, the interest rate that is got a yield spread of at least 2.25. There it is right there. So what this means is that this particular interest rate of 8.625, based on these variables, these values, this bank statement loan product and yada, 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 that particular par rate, 2.25, this is a yield spread, 2.25. What happens to my negative 2.25 from down here, my LLPAs, when I add a positive 2.25 yield spread premium for this particular rate on a 30-year fixed? Negative 225, positive 225, what happens? That's a 0, right? That's a par rate. So in that example, if any of you that work with us or have worked with us, you know that Ridge charges 2% origination on all of our non-owner occupied deals, almost without exclusion. That means that 8.625 interest rate, you're going to be paying 2 points because that's my compensation. There is no extra premium pricing here. This is called a par rate. Okay. Now let's just say that you didn't want to pay any points. All right. You didn't want to pay our 2 points origination. You wanted to try and build it into the interest rate. Well, if you know that we charge 2 points and your LLPAs are 2.25, that means that we've got to find an interest rate that is paying a yield spread of 4.25. Okay. Unfortunately, in this case, there is no such option. So the best that I could offer you in this scenario would be 9.75, and you'd be paying 5/8 of a percentage point, right? Because I still have to cover my 2.25. That leaves me, right? If I take 2.25 away from, forget about the 1 and the 0 here. That makes it confusing. The yield spread premium here is 3.625. Okay. So if my LLPAs in this case are 2.25, I have to subtract 2.25 from 3.625. Everybody with me? Is there any questions, Carly, that I might need to pause for?
Yeah, we did have one from Jeremy. Does the lock period add and subtract? He was referring to all the way up on the right hand side of the spreadsheet.
What did it say it again? I'm sorry, Carly.
Oh, no worries. Does the lock period add/subtract up on the right hand side?
Good. Thank you for the question. I don't know if that's you, JG, but thank you. So a 30-day lock is pretty traditional. There is no hit for that. The longer the lock period, the higher the cost and or the rate. Okay, so if you want to take an interest rate and secure that rate for a longer period of time, as you can see, you can expect to pay or secure a higher interest rate. So these negatives are an increase to the LLPA. These are price adjustments, not rate adjustments. Likewise, a shorter lock term usually will give you some kind of benefit. In this case, this particular rate sheet doesn't offer anything lower than a 30-day. But conventionally, you know, you've got 15, 30, 45, 60. We can even lock as high as 90 days, but there's an additional cost for it. But the longer the lock period, the higher the rate and or cost. Okay, good question. Okay, so let's go back to where I was. So if this individual didn't want to pay any points, I wouldn't be able to give them that offering today. It's not available. The best that they could get would be 9.75. And if I want to make my 2 points and I know my LLPAs are 2.25, they're going to have to pay 5/8 in points, or 0.625. Did I get that right? If you do the math. So 3.625, well, 4% minus 3.625, 3/8. Oh, but we had a quarter. I'm sorry. There's a quarter in the LLPA. Yeah, so I was right. 5/8 of a point. So I'm going to say that one more time because I think I just confused everybody. So remember, our LLPAs, loan level price adjustments, for this scenario, for this random old school rate sheet, were 2.25. Okay, Ridge is going to charge 2% origination. So there's 4.25 I got to cover somewhere. In this rate sheet's case, I don't have a 4.25, right? I'm short 0.625, or 5/8 of a percentage point to get that person there. But it's better than maybe paying the 2% origination. Maybe that makes more sense to them based on the deal, et cetera. So in this example, I could offer them 9.75, and instead of paying our 2 points origination, they'd only have to pay 0.625, or 5/8. Everything in mortgage, especially when we start talking, most often, not always, but most often, interest rates and LLPAs and stuff, they move 1/8 of a percentage point numbers. So you start at 0, 0.125, 0.25, 0.375, half a point, or 0.5, 0.625, 0.75, 0.875, and 1 whole point, right? They move 1/8 of a percentage points. Okay, so let me pause for questions. Anything that's timely, Carly, about what I'm talking about here?
No questions at the moment.
Okay, all right. So this would be a normal rate sheet where you see this premium pricing, right? These are positive numbers. This doesn't exist today, guys. When I look at a pricing rate sheet, that I use this just so you can kind of see some of the pluses and minuses. In reality, we have systems that, like I said before, we type in all of the variables of the transaction, and that will tell us what the pricing is for that day. And when I get the grid that kind of looks like this, all of the numbers that come back, okay, whatever the interest rates are, they're all sub 100. Okay, depending on the variables of the deal, I can't say exactly until I ran it, but there is no premium pricing that is producing positive numbers here, especially for investment type properties. So as a result of that, there are points in addition to what Ridge is compensated, right? Our 2 points that you're going to have to pay just to get in the door, just to lock in that interest rate. Non-owner occupied in particular is going to be on the higher end of what those LLPAs are, or these numbers are going to be more significant below that 100 mark. Okay, if it comes back and it says that for the rate that you want, let's say the rate that you want is 7%. Okay, this number could be, well, in this case, it's 98.5. So what that means is that just to get this rate, and forgetting about our 2 points that we're going to charge, it's going to cost you 1.5 points, right? Because I have to get to 100 to make that what we call, again, par. So 1.5 plus 98.5 is 100, right? And that's where the cost for this particular rate for these particular variables would put us. Now, okay, that would be if there were no LLPAs. Okay, I was just showing you what the difference between 7% and 98.5 meant. Without any LLPAs, it would be 1.5 points. Okay, now I have to take my 1.5 points. If you wanted 7%, I have to take 1.5 and add it to 2.25. Where are we at? 3.75 plus my 2 points. We're at 5.75 in this scenario just to get that 7% rate. Now, what you'd want to do in this case, because there might be other options, is figuring out what your payment difference, kind of going back to that first example I gave you in that math, how far do you want to pay it down? Loan amount is a big driver here too. The smaller loan sizes generally, gang, don't make, I used 100,000 as my example on the front end of this call because it's easy math, okay? The larger loan sizes make a bigger difference. 1/8 of a percentage point on $500,000 is going to be a damn sight higher than $8 a month difference in payment. So as I'm always harping on, you guys have to do the math. If you have those baseline details, how long are you going to keep the loan? What is the interest rate and the points associated at your quote? And what are the buy down rates? What are the costs to get the rate even lower? And what is the monthly savings? And you can figure out from that point on whether it makes sense to pay even more points. Comments, questions about any of this? Let me hear, hold on, let me stop sharing. I want to look at some of the faces here and see if we've lost anybody, or if people are either sleeping or they're like, what the freak is this girl talking about? Okay, everybody's got their pictures on. Lisa looks good. She's following. There's Eustace. Eustace is smiling at me. He's catching all this. All right. So if you guys have any questions, let me know. Okay. So let's talk about why. Why are there points right now? Many of you may have the answer to this. If anybody is feeling ambitious and wants to raise your hand and say, I'll answer it. You've got the mic. I'll let you answer. In the meantime, let me explain. So everybody knows we're in a high rate environment right now, right? Rates are high right now. That's where we are in this particular cycle. Inflation, all of the reasons that are associated with why we are where we are, pandemic, yada, yada, yada. Okay, rates are high. When rates go up, do they stay up? No. When rates are down and go down, do they stay down? No, they're fluid. They go up, they go down, and everything in between. When we look at where interest rates are going to be in the next 6 months or 12 months or 18 months, it is widely anticipated that interest rates are going to be coming back down. They've been up for a while. They're not going to stay there. Predicting when that's going to happen is not going to be part of this conversation, but I think that it's a foregone conclusion that sometime in the relatively near future, and I guess it depends on how you define near future, let's say a year, rates are going to start coming back down. As a result of that, the servicers, okay, here's another layer of complication and convoluted explanation that kind of plays into the why there is no premium pricing right now. Let me back up a step. So we talk about mortgage-backed securities, and most of you know that Ridge Lending is a direct lender in that we fund on our warehouse line, we underwrite in-house, but we don't hold these mortgages and service them. Meaning when you guys start sending your mortgage payments in to be paid and distributed to the investor for the principal and the interest, and the taxes go to the county and the insurance goes to your agent, we don't handle that, okay? We don't service these loans. What we will do is we're gonna bundle mortgage-backed securities in chunks of 5 million or 10 million or whatever it is, and we're gonna resell them on the secondary market to investors, to servicers. The servicers are gonna pick up the rights to service this portfolio of mortgage-backed securities. And as a result of that, they're going to pay a premium on the rights to service. Okay. Usually it's 1%. All right. So whatever the value of the mortgage-backed securities being purchased, they're going to use 1% typically and purchase the rights to service. In mortgage, it takes about 36 months to recapture the cost, that upfront cost servicer pays for the rights to service that loan. So it's going to be about 3 years down the road before that company, before that entity is going to be profitable. Okay, they're hedging because after 36 months, then they're going to be more profit. They're going to see a profit on the work and the servicing that they're doing within those mortgage-backed securities. Well, okay, that's fantastic, but they know they have, well, they've got 20/20 hindsight. They know that interest rates that are high today are going to be refinanced tomorrow, and probably much, much sooner than they're 3-year or 36-month break even. So if they know that these loans are going to refinance because rates are high right now, and the loans that they are buying today, the servicing rights today, they're not going to have 36 months down the road, right? They're going to refinance and pay off because rates are going to be coming down. You guys are probably, a lot of people are going to be refinancing out of the rates that they got today, last month, last year, into a lower rate in the coming 12 months. What does that mean? They're going to be out that initial capital, right? That premium that they paid for those servicing rights. So that's why there's no premium pricing right now. And that's why you're paying extra points. They've got to cover that margin for the losses that they're going to be taking in 6 months or 12 months or 18 months. Clear as mud, right? How you guys doing? All right, I'm gonna mandate. Sometimes you guys are gonna have to get off your static images. I want to see your faces, especially when I start talking about crazy stuff like that, just to make sure that nobody is going into a coma or
Darnetta did say that this was a good breakdown.
Good.
And
Okay.
Martha, she said, I will need to watch this again. So
Yeah,
yeah,
it's
understood.
high level stuff, gang. And it's not super easy to assimilate with and certainly retain. You're going to want to hear it again and again and again and watch it. And if there was anything about today's conversation that needs further explanation, you know how to get us, let us know. We'll add it to our weekly topics. But let me open up for questions. Anybody have anything? I see a few deer in the headlights. Not Philip looks good. He looks like he got most of that. He's looking sharp. There's Dad.
I do have one question here, Caeli. So that's why we are paying extra points, or that's what lock fees are?
Same thing.
Okay.
Lock fees and extra points, same, right? I mean, we call them lock fees. It's probably not a great descriptive for what it actually is. It's just the language barrier. Probably it's just we call them in our world. But those lock fees are that lack of premium pricing or the lack of spread when we do the math to figure out the LLPA and what the rate, if there's no yield. So what I showed you guys, let me just do it one more time. Hold on. So when you look at this is old. You can't get these very often anymore, this kind of a rate sheet, right? Everything is automated. So when you guys see premium pricing, this is premium pricing. Technically, this would be premium pricing. Forget about the LLPAs for a second. 8.375 is paying a premium, okay? Depending on what the scenario, the variety of variables are attached, positive or negative, to that particular interest rate. Not very often are you even seeing any premium pricing, even for owner occupied. A lot of times having that choice to increase the interest rate to cover the spreads, whether that be the lender's compensation or the LLPAs or what have you, it isn't available for the reasons that I just described, because the servicers know they're going to be taking losses, and probably pretty big losses, when all of the loans that were secured in the last 12 to 18 months go to refi, and many of them will, not all of them, but many of them will. And that upfront premium they paid for the servicing rights will not have been profitable. They'll be in the red. So they are not producing that premium pricing. Any more questions? Don't be shy. No dumb questions here, gang. Remember, I've been doing this for 25 years, and I still learn something new almost daily. Nothing? Okay. Does anybody have nothing, Carly?
Oh, it looks like we just got one. Let's see here. Okay, so do the negative LLPAs subtract from your 2%?
No, you would add them too, because it's a cost. So if you think about premium pricing as a positive number, right? If the yield spread on an interest rate, if it was a positive number, it's got to cover the LLPAs, right, associated with the variables of your transaction, Philip, plus our compensation. Now, under normal market circumstances, okay, try to put everything I've set aside just for a second. And under normal market circumstances, The advice that we give most of our clients on a buy and hold strategy, totally different conversation for a shorter term investment or some kind of a fix and flip. You probably want to pay additional points when interest rates are low enough and we know that you're not going to be refinancing or refinancing within the window of time that math, that break even math is there. The math is easy enough to identify by saying, and keep in mind, you guys, the pricing changes daily. So what might be viable to buy points down today in a normal market environment may not be tomorrow, right? But then the next day it might be viable again. So it's changing constantly. But Philip, it's adding to. So if the LLPA is a negative number, then our points are being added to that. If the LLPA is a positive number, let's say that the loan level price adjustments for your scenario come back and you have a positive 0.5%, and we charge 2, then in that case, we'd only be charging 1.5, because based on that interest rate that we have chosen, that half positive is going to cover half of our 2 points that we're going to charge, right? Or what we could do instead is look at the rate below that and see if you're really looking for that par rate, right? Where the interest rate yield and the LLPAs match as close to as possible, and make that 0. And then you're paying the 2 points origination, or right, however that ends up shaking out. Anything else?
Yes.
Good question, Philip. Thank you.
We do have a couple more. So Edwin asks, sorry if I missed it, but what are current rates looking like? Up, I assume.
They're up. Thank you, Edwin. You guys know how much I love talking about interest rates. Thanks, buddy. Yeah, they're up. I'm going to say, but remember, so this is subjective to the LLPAs, right? And I'm constantly, because everybody, so I'll tell you, and we kind of have a joke in our industry. I'll give you guys a little bit of insider fodder, comic relief. First thing on the phone, what's the interest rate, right? Before we've even had anything else to talk about, we have no information. What's your rate? What do you want it to be? So it's very, very dependent on what's the scenario? What's the loan amount? What's the occupancy? What's your credit score? What's the property type? Is this a cash out? Is it a purchase? Once we've been able to identify all of that, we're able to give at least a range or a good baseline, as it would be that at that point in time of the day, et cetera. So that said, let me quantify first, and then I'll give you where the range is. Okay, Edwin? Let's say it's a purchase. Let's say it's 25% down, and let's say that loan amount is 100 grand to 150. If you guys remember on that sheet, they go in tiers, right? So the LTV is 50 to 55, 55 to 60, right? And then if you remember, the loan amounts also, they have the tiers. So let's say that in my example again, 100,000 to 150 is the tier. You're within that range. 760 or better credit. And I said it was a purchase, it's an investment property, a single family residence, DTI is below 43%. So all of those variables, you're probably today going to be at about, I'm going to say 7 to 7.25, I think. I should probably have pulled this up while I was talking to you guys. I'm going to give you that as the range, and they probably are additional lock fee points, or in addition to our 2 points, there's probably additional points associated with that interest rate quote. And there's going to be a cap too. There's something else called off-sheet pricing, where the secondary markets are going to give us kind of that rate sheet, and the rates will cap, and they won't go above, say, 7.5, right? Which I think is lame. I think they should give us the opportunity and take the higher interest rate and adjust that premium a little bit, so people have more flexibility and room to make more decisions. But if it's capped at 7 and there's no room above that, there's nothing else. Because remember, the higher the rate, the higher the yield spread premium, or the lower the cost. Does that make sense? Let me share my screen one more time, you guys. The higher the interest rate, where's my share? So the lower the rate is up here, right? You guys can see me. So 6.625 is the lowest rate on this rate sheet. 9.75 is the highest rate. So the higher the rate, the higher the yield spread. The lower the rate, the higher the cost. the further away from that 100% or par that we're going to get. Okay. And that's true not just for this rate sheet, for any. The lower the rate, the higher the cost. The higher the rate, usually we expect the higher the premium, which we don't really have access to right now. And you know why. That was a ton. I hope you guys were able to track and follow some of that. I hope I didn't overstep my bounds by offering information that might be, way over and above what you ever really need to know or want to know. But I hope you got some value out of it. Anybody want to, well, we've got a minute left because I booked this through 2:30. Anybody want to ask any questions about topics or offer any ideas about topics for next week, the week after, anything that you want to hear about or talk about? I was thinking next week I would talk about some of the advantages and disadvantages of amortized mortgages versus revolving open-ended, closed-ended amortized versus open-ended revolving as it relates to investment properties. So I thought I would talk about that. Could we get a copy of that spreadsheet to digest? Maybe. It's not for public consumption. I'll see if there's stuff on there, if I can get rid of anything that might get me into trouble. Yes, I will make it available on the community, and you guys can have access to it. Yeah, I'm sure that there's some way I can redact anything that would be sensitive, and you guys can get your hands on that and then ask follow-up questions. So yeah, I was thinking about amortization versus revolving open-ended mortgages and pros and cons, and talking about that next week. Or I could talk about, again, I thought this would be a good rerun. I recently have been having some questions about borrowers wanting to get into a 15-year fixed mortgage, which I am a huge deterrent of. I'm never, ever, ever going to allow any of my clients to take a shorter amortization mortgage unless, they're cracking in $100,000 a month in income and their debt to income ratio is like a 1%, right? Which I don't have any clients like that. So we could do that too. So my point is, let me know if you guys have any other thoughts. Otherwise, I'll figure out what we want to talk about, and you guys get to just enjoy.
Yeah, we got some here from Katia. She said how to underwrite deals in this environment. And also Eustace had a question. He heard on Bigger Pockets that some lenders will use your existing assets as collateral. Is that something that we offer?
Existing assets as collateral. Tell me what you mean, Eustace. You mean as income, like an asset depletion, or do you mean if you're trying to do a commercial loan and the LTV just on the real property by itself isn't making the spread, and you've got assets over here that you can kind of add into the mix to make the deal more sound from a banking perspective? Is that what you mean?
I'm going to go ahead and unmute you, Eustace, so you can go ahead and answer us. Oh, let's see here.
There he is.
Hi, can you guys hear me?
I can hear you.
Great, thanks for taking my question. So on the Bigger Pocket show a few weeks ago, there was the guest said that he had an existing property that he owned, which did not have a mortgage on it, and the lender allowed him to use the property as collateral without refinancing it or anything to take out a mortgage.
I think I know what you're saying, and the answer is yes. We have products that will, let's say, for example, you found some properties, you found a package of 3 properties that you would like to purchase, and the down payment, you're a little bit shy in your actual cash. So you're going to add in this free and clear property as collateral to offset what you might be deficient in the 20% or 25% down. Is that right?
Yes, but in the example that he gave, he didn't put any of his own money down. So it's not that he was short on cash. He didn't put any cash. He wasn't required to put any cash down.
If the equity in the property, this free and clear property, is enough using a cap in loan to value. So let's say that he needed $80,000 for the down payment and all in, et cetera, blah, blah, blah. and the property that he had over here was worth $100,000, and the limit is 80% that they will leverage or cross collateralize. In that scenario, yes, that works.
Awesome.
So yes, you can absolutely do that. Yeah, and we have products that can accommodate that as well. And speaking of bigger pockets, you guys, just heads up. I don't know if I told you this last week or the week before. I'm kind of excited. I am going to be featured as on a lender panel. I can't remember the name of it, but I think it's the 18th, right, Carly? Isn't that when they're publishing that?
Let's see. Yes, that is Tuesday, the 18th.
So I'll be on Bigger Pockets. I'm embarrassed to say I'm totally spacing the other guy's name. Very cool, very smart guy. But it might be worth you checking out. So well, obviously when we get access to it, we'll blast it across our airwaves too. So you'll know from us when it's out there. But yeah, okay. Who else? Anybody else in just quick last minutes, Carly, that had anything we didn't catch?
No, just some thank yous for the great info and for the talk. And I think we caught all those questions.
Sweet. I'm gonna go finish my pie. See you guys. I'll see you guys next week. Thanks for coming. Bye, gang.